Welcome, everyone. How to stop CRA from taking your OAS in 2025. If you don't plan for your retirement income carefully, CRA might claw back thousands of benefits from your OAS. We don't want that to happen. That's what this video is all about. We're going to start by determining what is the clawback and then how to avoid it. So, Kevin, what's the clawback?
Exactly. We want to give a little bit of a presentation here as to what it is. We'll keep it brief. So OAS is basically pension that you receive for seniors in Canada. It is based on residency. It's not based on direct contributions. If you live in Canada over 10 years and are over the age of 18, you qualify. To get the max, you must have been in Canada 40 years after the age of 18. It's funded by federal or general tax revenue for the federal government. OAS payments will start at 65, but can start later. You can wait until 70. You know, your payments are adjusted for inflation on a quarterly basis. So that's sort of a big scenario as to what it is. But what numbers are we dealing with otherwise?
Yeah, so that's the OAS benefits. That's the program, how it works. The clawback, or the recovery tax, is how it's formerly known. The clawback, you make too much money, they start taking some of that benefit away. The threshold does change. It's not the same every year. Right now, it's $90,977, or roughly $91,000 of income. So you file your 2024 tax return. On that tax return, if your income's above that $90,977, they start clawing back your OAS. Important note, individual income, not household, is per individual. And for every dollar above that threshold, they take 15 cents of your OAS back. It's like a 15% extra tax. That's what the clawback is. We're going to go through an example of how that works, but important before we do the example, federal government uses data from your tax return to determine whether or not you're over the threshold. Specifically, they look at line 23,400 of your tax return. That's going to come important later. And the returns, you file it by the end of April. So in April 2025, I filed my 2024 return. The government's going to use that data and then make an adjustment. They usually make their adjustments in July. So July of 25, they'll make adjustments based on your 2024 tax return. And they may change how much OAS you receive. So they look at that July through June period as their 12-month cycle to make adjustments. Now, here's a quick example explaining that.
So that's the biggest factor. Remember, it's not yearly. It's not January to December. It's July through to June each year. When we look at the example we want to deal with, you're filing your 2024 tax return in April of 25, which of course is normally done. If your net income before adjustments, let's say, is $110,000, of course, as we mentioned, the threshold is roughly $91,000. So you're over by a little over $19,000, which is the 110 minus the 91, and your reduction is $2,853.45. Now that's 15% of that $19,000 that we're dealing with. So if you're looking at it July 2025, when your OAS payments are done again, your OAS is going to drop by roughly $238, which of course is the number that we figured out divided by 12. So if you were getting sort of the maximum beforehand, it's going to be reduced by this much going forward. That's something that you have to look at. That's how they calculate what they're going to pay.
Yeah, and we'll go through now some common triggers that could bump your income, that could end up with you clawing back your OAS, and then how to avoid them, strategies to avoid them. Some of the common triggers, capital gains triggered by asset sale. You're selling a cottage, a rental property. Maybe you sold the stock in a non-registered account. All of that could trigger capital gains, which may bump up your income. RSP and RRIF withdrawals in retirement, that's a very common theme. Taking money out of those RSPs, out of those RRIFs. All of that counts as income, which could bump your income up, maybe over that threshold. Investment income, if you have a non-registered account. If all you have is an RSP, TFSA, this part not as applicable, but if you do have a non-registered account, the dividends, the interest you earn there could bump up your income, perhaps over that threshold. And then part-time work. This is one that sometimes folks don't consider, but maybe you're collecting money from your investments or getting some CPP OAS, and then you're going back to work, so you want to take a big vacation and use that income from work to go on that big vacation. Well, when the government looks at that line 23,400 on your tax return, they add all of it up, and that combined total could push you above the threshold. That's the common triggers that we see. Strategies to avoid your OAS clawback. Well, all the strategies pretty much focus on trying to reduce your individual taxable income below the threshold. That's really the thrust of all the strategies. And we're going to get into a couple of them right now.
Yeah, so how we want to avoid that again, I mean, there's only certain ways. If you're getting things done, if you're a married couple, of course, the biggest advantage you got there is you got income splitting. So if one is earning a whole bunch of money, the other one isn't, you can income split, get both of them below that $91,000 mark that you got in, and you won't have to worry about the OAS clawback. Now, also timing your capital gains, as Clint mentioned before, sale of a cottage. Well, let's assume that you want to do that. Well, you don't want to do it when you're getting the most money in, because that's just going to trigger a whole bunch more that you're earning, and the government's going to claw that back. So timing it, whether you're selling a big stock, whether you're selling a cottage, when that's done in your non-registered account, make sure that you try to look at the timing of the capital gains. So maybe you don't have to do it, or if it's a 1 year thing, you can get all done at 1 year with all these things going forward. And then monitoring your RSP and RRIF withdrawals. So if you're drawing down early, maybe you're looking at something along the lines of using the age of your spouse. So as opposed to the 5.25 at 71, if your spouse is 66, as we can see, now you're looking at something around the percentage of 4.17. Maybe that keeps you under that 91,000 that you're looking at, so you don't have to worry about it. Those are some of the basics that we can look at for how to start to avoid those OAS clawbacks.
Yeah, and related to the RRIF, you have the minimum, which you just talked about.
That's
Maybe
right.
you use the age of your spouse to reduce the minimum you take out. You also have the RSP RRIF meltdown. We got lots of videos on that, so we won't go over it now. But the idea of reducing how much you have in those accounts strategically, so you have less later on in retirement. We'll get through a few more strategies to avoid the OAS clawback. But first, we get lots of questions on this. If you have a question, how do folks get a hold of us?
You go to chatwithclintonkevin.com. By all means, if you want any more on the OAS, how the clawback works, or anything on how OAS works in general, CPP, anything like that, send the questions in to us, or any other financial matters that you have. We're more than happy to answer and do what we can for it. Those go directly to Clinton and myself, and we'll get back to you as quickly as we can with the answers to what your questions are. But also, beyond that, we have something else.
We have a newsletter, which if you like these videos, you'll probably like the newsletter. Newsletter is weekly. We got lots of tips on taxes, on retirement planning, on items just like we tackled in this video. So if you'd like to receive the newsletter, there is a link in the description. You can click on that and sign up. Getting back to the OAS clawback, we talked about a couple of strategies: income splitting, timing the capital gains, monitoring the RSP and RRIF withdrawals, a few others, watching the part-time work, because part-time work does increase your income, and then deferring your OAS and CPP. Usually this is a combined factor. So you might watch the part-time work. How would you do that? Well, maybe you defer your CPP OAS, you work part-time, you're deferring the CPP OAS. They can't claw back the OAS if you're not collecting it, if you defer it. Also lowers your income, which could give you another opportunity to have that part-time work and be under the threshold. Combining it with something Kevin mentioned earlier, but RSP and RRIF withdrawals.
That's right.
If you're taking lots out of the RSP and RRIF, maybe as part of a meltdown strategy, well, you could defer your CPP OAS. You don't have to worry about the threshold then. You can take more out of the accounts during that period. And when you do start collecting your CPP OAS, they're going to be bigger because you got a bonus for deferring, and you now have less than the RSP and RRIF, so it'd be less of a headache for you. So you can see you can combine a few of these strategies. Another one on that list is asset location. This really applies if you have a non-registered account. Which investments do you hold in that account? I'll let you go through the asset.
Yeah, I mean, basically, if you're earning pure income, you've got GICs or fixed income investments like bonds, you're going to get paid total income. That's the income that's added in. It's all fully taxable at that rate. You may want to look at some other options. You may want to look at the dividends, which have a dividend tax credit. So you're not paying as much. You're already getting some of that back. So you're not showing the government as much. You could have capital gains. Again, sale of the cottage and things like that have always come through. Basically, what you're getting is you're only showing the government half. So if you can get things that are less tax or more tax efficient and less non-tax efficient, like income, you want more dividends, more capital gains, more return of capital. Those are all going to help with you going forward because you don't have to show the government as much. You're not claiming as much, and you still have some income coming in from that.
Yeah, so it lowers your income. The whole idea, get that income below the threshold. And very important point, whenever you talk investments, taxes are important. They're not the most important, though. You want to make sure it follows your plan. You want to make sure it achieves your goals. You're comfortable with the risk level, and then you worry about the taxes. So don't put the tax top of the list, and then you end up in a risky investment that's tax efficient, but you're not comfortable with. So you have to get the order right. So we talked about what might work to get rid of the clawback and save your OAS. What won't work, some of the items we've heard people suggest that don't really fit, and this comes back to how they do the calculation, specifically line 23,400 of that tax return. One of the items that won't work is charitable donations.
That's right. The charitable donation scenario doesn't have a problem because basically what they're doing is it is a tax credit. You're not worried about it, so it's not really affecting that line. OAS clawback calculations use that 23,400 line. So typical tax credits, like those for charitable donations, they recuse tax payable, which is lowering your tax bill, but does not impact your OAS clawback level. That's a huge factor to remember. So if you're making charitable donations, that's great. It's going to lower everything you got, but that's not going to affect your OAS because of where it comes in on the tax return and how things are reported.
And another one that won't help you avoid the clawback is capital losses. Now, if you have a capital gain, let's say I bought a rental property for $100,000 and I sold it for $150,000. Fantastic, made $50,000 of a capital gain. Half of that, $25,000, will have to be included as income on my tax return. And then maybe I lost money in another property. The loss can be used to offset the gain. I don't pay the tax. That's fantastic,
Yep.
except for how they calculate the OAS clawback, because they use that line 23,400. Keep coming back to that because it's important. The capital gain bump to income is included in there.
Yes.
The reduction you get from capital losses comes afterward. It comes later in the tax return. So the capital loss will save money. You'll save taxes. It will not help you with the OAS clawback. A little wrinkle of the system that does not work in your favor. So those capital losses can help you save tax, help you save money, won't help you avoid the OAS clawback.
Yeah, so it's very important to always remember 23,400 is the line you have to look at. Everything's calculated before that. Most of your deductions are calculated after that. So you got to be very careful as to how you report your income going on. And of course, if we want to do things, what's one of the main reasons or main ways to try and avoid all this? Well, you need to have a plan. The Becker Orr mantra is have a plan. Make sure you've got that. OAS clawback is assessed annually. So remember, that's one of the things to look at is that maybe you have all these big gains in one year. Okay, if you're not going to have them the next year, yes, you're going to be affected for 1 year. But as we've mentioned before, this is recalculated on an annual basis. So 1 year you may get it clawed back. The next year, if you don't have any of those gains, it may go back to where it was beforehand.
It could be fully restored. Temporary spike, OAS clawback, an annual item. And of course, it always has to fit within your overall plan. So don't just implement a strategy ad hoc. You want to make sure it makes sense within the larger plan and your overall financial planning goals. If you like this video, certainly you'll love the video floating on the screen now, all about the increase to CPP in 2025 and how that can help you out. Click on that one. We'll see you again very soon.
Take care.